Okay, we have people logging in. Great. So once again, my name is Lorraine Gilbert, CEO of WealthWise Financial. Today is August 27th, and we welcome you to our WealthWise Viewpoint webinar series. This is a series that we do every month with different topics that we think are going to be helpful to you. Now, I know that the title of this webinar is talking about uncertain times. And I want to let you know that a lot of this information that we're going to be sharing, it will be helpful to your kids and to your grandkids. A lot of it is going to be helpful to people who are in transition and maybe with the job market as things slow down, looking at what that might mean. There is some very good information in here. I just want to set the stage. If you logged in because you want to hear about the uncertain times in the market, I think, John, what we'll do is we will cover that after Janet finishes her presentation. So we are grateful to have our New York Life representatives here today to do a webinar with us. Keith McDonald, who is on the line. Keith has been with New York Life and Mainstay Funds since 2006, and I have known Keith that long in the industry. So Keith, I know we can't see you, but thank you for being here. And if you'll please introduce Janet.
Of course. Good afternoon. And Maureen, thank you so much. And thank you for the opportunity for us to talk with your client. And Janet Coe has been an incredible partner with me for well over a decade. I've been covering Southern California, south of Los Angeles, for over 18 years with New York Life Investments. Janet is the director of Advisor Advancement Institute at New York Life Investments. And in her role, Janet's responsible for the development and delivery of practice management, thought leadership to assist both senior management and advisors in understanding the key trends in best practices in asset management and wealth management. Janet joined New York Life Investments in 2009 as an internal sales consultant before moving to Global Relationship Management Group in 2011 as a relationship manager covering key account relationships in the wire and independent channels. She began her career in financial services industry as an advisor with Smith Barney in Honolulu, Hawaii, and in New York City, New York. She earned her Bachelor of Arts degree in psychology from Barnard College of Columbia University and holds her Series 763, 65 FINRA registrations and is a CE certified speaker. So with that, I will turn it over to Janet. Janet?
Thanks so much, Keith. It's been a pleasure working with you all these years, even though I hate to admit that we've been working together for this long, because who knew time flies when you're having fun, right? That's what they all say. Thank you all for joining us this afternoon, and thank you for the opportunity for us to be able to present to you today in your monthly webinar series. So I wanted to make sure we thank Maureen, Chris, and John. And for those who are on the call, as we're going through the presentation, there may be some things that stick out in your mind. We really want to make sure that you are bringing these thoughts to your meetings with them, because this is an integral part and journey that you're doing together with them. I mean, that's the whole reason why you're working with an advisor, with an advisory team. So I'm going to try to share my screen. Let's see, and hopefully this will work. Okay, let's do this so I can do the slideshow. All right. Okay. So I think we can all see our screen. As Keith was mentioning in my bio, I've been with our practice management team, really focusing on what we can do as an asset manager. We're with New York Life Investments, to really be able to help not only provide investment solutions for WealthWise to be able to share with you all, but also what else we can do to kind of help build out the practice. And some of our research studies, we've learned there's this incredible need for education, and education across the board. Even when you're working with advisors, it's still, because for us, while we're in the business, and as Keith mentioned, I started, oh my gosh, almost 20 years ago in financial services, only because I'm in it was I able to learn a lot more about the nuances, the things that I should be paying attention to, because quite frankly, before I got into financial services, I didn't really think about it all that much. So we developed an entire program, if you will, of various topics to help you get more comfortable, feel more comfortable, ask the appropriate questions for your individual needs with your team to be able to make sure that you are getting to where you want to go with your financial goals, with your goals, your next generation's goals. So with that in mind, today we're focusing on what we can do to prepare for uncertain times. Obviously, when things happen that are out of our control, we can only do the best possible to prepare for those situations. And what is that when it comes to financials? Because when we think about it, any life event, right? Whether it's a small event, whether it's a big event, a lot of times, the bigger the emergency, the bigger the hit that it takes on your finances. And if you're not prepared for it, it puts you in a harder spot to be able to get out of it. And I know that obviously Lorraine and John and Chris are helping you through that process to not get to that point. But there are some things to kind of consider and think about for yourselves to be working on in this joint relationship on your financial journey. So we're going to, over the next course of 10, 15, 20 minutes or so, we'll talk about 3 different focuses. Managing your debt. What does this look like? And I know, Lorraine, thank you very much for mentioning this at the top. This is information that's really great for you, but also the next generation, specifically those who are getting themselves ready to go to college, getting to leave college and go out of school and go into the workforce. What are the things that we can do to help them as it relates to debt? Because that's really going to play a key part when we fall on some hard times, and those hard times being an unexpected job loss, right? If you've been trying to save and earn and send the other and it's unexpected, that puts you in a situation where if you're not ready, that really kind of binds you a lot more. So then from managing the debt, preparing, how do we start preparing for that as best as possible? And then should this happen to you, and whether or not it happens to you, just to know if unemployment, if you are in a situation where you weren't expecting to suddenly lose your job, what should you be doing? What are the things that you should be focusing on? Debt. We have a massive debt problem. By we, I mean Americans. That's not new. That's just unfortunately the truth. And we need to make sure that we get a handle on it. And the best way to do that is to know early on as possible. So we'll go over managing your student loans for those who have student loans. What does that look like? The second part being credit card debt, which oftentimes is one of the things that really breaks down people and households, right? The credit card debt just keeps growing and growing and growing. And how do you get yourself out of it? Then, of course, addressing any mortgage situations where that could obviously be affected if you suddenly lost your job. When we think about student loans, you've got two different types of student loans. You've got your federal student loans, which generally interest rate starts at 0, and then we'll take on an interest rate once you leave school, and then will progressively increase. If you find yourself in a situation where you no longer have a job or you no longer have the ability to be able to pay this student loan off, we recommend, and you definitely should do this, update your income levels, because a lot of that will be based off of what you are able to pay. And you might even have a chance to be able to lower that interest rate that you owe on the loan that you've taken. This is again on those federal student loans. There is a difference where you can do a federal student loan, but you can also do your own private student loans as well. Whatever is not covered on the federal side, you can look into private side to get an additional loan in order to pay for college. You want to make sure that you read all the nuances that are in there, because there's going to be some differences in terms of both interest rate paying off, but also what happens in a situation if you are not able to pay that off. There are various programs that are out there to be able to help you in the situation where suddenly you've lost your job and you're not able to make this monthly payment. Now, this is, again, once you leave school. So these are just situations when you're out of school and start having to pay back some of these loans. For those who are finding themselves in credit card debt and managing that credit card debt, a couple things. If you do have a large balance on your credit card, you are able to apply for a transfer there. And as you can see here, there's going to be a fee that's involved. In order to do that, first, when you're calling your bank, your credit card company in order to ask for that transferability, you need to make sure that your credit score is 680 and above out of the max of the 850. How can you boost your credit score? Think about all the credit cards that you actually have. What is the balance on those, or what is the amount that you can borrow against? Start working on trying to stay below 30%. If you're able to stay 30% below what the maximum ability of what you can borrow up to, that significantly helps your credit card, your credit score. Additionally, making sure that there are no late payments, making sure that if you can, up to this point beforehand, get in the practice of being able to pay it off on a monthly basis. That also shows credit companies, TransUnion, Equifax, Experian, the three major reporting agencies, your ability to stay within a budget and your ability to be able to pay regularly, indicating that you are a good candidate to lend to. That will help increase your credit score. The other thing to also keep in mind that is a big component when it comes to your credit score is also going to be the history of how long you've had that credit card open. It's not the number of credit cards that are open, and actually having multiple credit card lines open may actually hurt you. You want to show more the longer history, and of that history, whether it's 5 years, 8 years, 10 years, the ability to be able to pay that off regularly, or at least at the very minimum, not having any late payments. That'll help your credit score get to be above that 680. Similar to not spending, or rather spending 30% less than what you are able to spend. When it comes to lenders, when they're looking at you, they also want to see how you're managing your overall debt and your income that's coming in. There too, you want to try to start making sure that you're getting in the habit, spending less than 30% overall, not just in your credit cards. If you find yourself in a situation where you aren't able to pay your card in full on a monthly basis, at the very least, because this affects your credit score, make sure that you're paying the minimum. You do not want to show any late payments. You certainly don't want to show more than two late payments back to back, because that's going to impact your score negatively as well. There may be some opportunities where you can actually call your credit card companies and ask if there is a hardship plan that you can get on, or a better payment plan, or even a potential, if you've shown history of using your credit card in a way that indicates that you're a strong lender or borrower, then you could also ask to get your credit card interest rates reduced. The other side to also increase your credit score would be to actually call your credit card companies and ask them for a credit limit increase. By no means am I saying spend more. It's more to have that increase so that you get a little bit more of that buffer in that 30%, the spending limit of trying to stay below that 30%. Now, this is all things that you want to do now, as opposed to once you're in the situation where you need to access these funds, use these funds, or have to reach out to credit card companies to ask for these hardship plans.
Janet, while we're on this idea of credit cards, I would just like to add a point, and that is that with the recent data breach that happened, and this one was quite extensive, with social security numbers that have been exposed, I am suggesting to clients that they freeze their credit. I did it on my own credit with all three of the bureaus, so that nobody can open a credit card or take a loan without it. You know, when your credit is frozen, you cannot access credit cards or loans. So that just means that if in the future I want a new credit card, or I need, some kind of loan, then I would have to unfreeze it for that period of time. But given the magnitude of this, and given what we're seeing is more and more of these data breaches, I think it's highly suggested.
Absolutely, 100% agree with you, and thank you for that reminder. Yeah, there's no harm to you to freeze your account. If anything, it just gives you that additional protection, because a lot of times when you think about that credit card fraud, when you think about Social Security fraud, all of that happens because someone's been able to tap into your credit. If you freeze your accounts, then they are no longer able to. And even better, when someone does try, you get an alert. It'll come to you, and you'll also realize, like, oh my gosh, this has happened. So you also want to get in the process of not just freezing your credit scores on the 3 different agencies. You also want to make sure that you're checking your credit on a regular basis. And when I say checking your credit, not just the credit score in and of itself, but go through the reports to make sure that there are no funky home addresses. There are no funky accounts that have been added to your name, because that's a great way. If maybe it didn't happen through the breach, or you hadn't frozen the account yet, someone was able to get into it. Make sure you do those. And when you look at all 3 credit reporting agencies, pro tip, don't do it all at once, because all of them are pretty much pulling the data from the same sources. So I would say actually pull one from Experian at the beginning of the year. Pull another one from Equifax, maybe in between Q2 and Q3. Pull another one right after the holidays, or even right before we go into the holiday season, and then freeze your accounts, because a lot of theft, unfortunately, happens before the holidays. So these are ways in which you can protect yourself and stay in front of these situations to really protect your own credit score.
Yeah, and there is the annual creditreport.com
That's correct.
that offers that for free.
Yeah, I would absolutely take advantage of all of those. And I actually do myself, because I did have my purse stolen. 20 years ago, and at that time, I wasn't aware that you're not supposed to carry all your credit cards in your wallet. And it was kind of a nightmare to go through all of that. But the lesson learned: freeze your account, but more importantly, check your credit score regularly and make sure you're looking. It might feel annoying, but it's so much more worth it than having to deal with, okay, there's been an account that's been open and now I need to address this. So thank you. That's the debt side of it. What can we do to kind of prepare for these potential hardships that may be coming, right? Whether they're for you or whether it's a loved one that's going to be going through it. Couple of things right off the bat as you're building your wealth, and I'm sure Lorene and John and Chris are talking to you about this. Make sure that you're building your savings, your emergency fund. As we get older, emergencies get more expensive. With that in mind, traditional thought used to actually be 10, 15 years ago, maybe 3 months worth of what your monthly expenses are. So your mortgage, your car payment, all the things that are fixed that absolutely go out on a monthly basis, student loans, repaying those, all of those. If you add that all up, what you ultimately want to do is start saving aside emergency in cash 6 months worth, just in case something happens. And this isn't just to job loss, but I mean, we just all went through an incredible pandemic where a lot of our jobs weren't those that, so we lost our jobs because of the pandemic, because they weren't jobs to go to. In order to still continue to live your life and prepare yourself for this, and I'm not saying that we're going to have another one, but we need to prepare the best as possible. Make sure that you're setting aside 6 months worth. Only then, and as you're doing that, make sure, and this is something that certainly Lorene and John and Chris will be able to help you find different opportunities where there is other cash that you can tap into. And at the very, very, very last resort, if absolutely you have to open another account, another credit card account, you can, but opening another credit card account doesn't help your credit score. So keep that in mind. That's really going to be your absolute last. What you really want to do first is set aside that savings and identify any other potential cash resources or that's what's available. Use those to cover your fixed expenses until you are out of a situation where you're able to kind of manage.
And Janet, I'd love to add another thing here that that over the past few years we've done quite a bit of with clients, and that is collateralize their investment accounts for certain more shorter term needs. So we, for instance, just had a client purchase another home, a home. She wasn't ready to sell her existing home, so wanted to get into the new home first and was buying that in cash. So what we did is we collateralized an account so she could do that. And now she's going to sell the house that she's in and be able to replenish and pay off that debt. So that's another use of that a lot of people don't think about, is that idea of collateralization. And we've done it a number of times for different client situations.
Another perfect example of how you can find other resources to be able to access the monies that you need in order to kind of get by. The next topic isn't a fun one, because budgeting, who really wants to budget, but it's incredibly important, and this will help in that preparation. The earlier you start on a budgeting process and you get used to and more comfortable with it, the better off you're going to be in the end. When we think about your budget, it really is going to be, what are you bringing in and what absolutely needs to go out? Think about all the things that absolutely need to go out. Really ask yourself, does this absolutely need to get paid? Now, for a very long time, I didn't have to pay for my gray coverage, but that absolutely happens every 6 weeks. And that is going to be part of my fixed expenses. Like, what are the things that you need to do and pay out for? Prepare as best as possible for that. As you kind of go through this exercise, adjust what you don't absolutely have to pay for, because it just gives you a little bit more to set aside and save, and then also gives you a chance to be able to put more, whether it is investing and whether it is putting into an account where you can ultimately then collateralize against it. Budgeting doesn't have to be this massive undertaking. It's just something that you want to stick to in order for you to be able to prepare for those difficult times that may come. And these are all things that obviously you're going to talk to WealthWise for, if that's what they're here for.
Yeah, and let me just add that this is exactly what we do in Wealth Vision. We put in all expenses. So it's a cash flow analysis tool of money coming in, money going out. And the better handle we have on your expenses, we can then delineate the way that Janet has here between fixed expenses and variable, so that when those times come that you may need to make some adjustments, we know what the variable component is versus what the fixed expenses are. And so we do this in our financial planning tool.
Definitely make sure that you are participating in those meetings to be a part of that financial planning process. That's going to be incredibly key. And if you have certain things come up, make sure that you're sharing it so that they're aware, to be able to help you have everything in one place. You know what you need to do and adjust plans accordingly. And this is something that obviously you're going to talk to them about as well with Lorraine. When we start to face difficult times, we find ourselves in kind of a chaotic mode, right? Our mentality is, oh no, I need to make sure that everything is secure and I need to change things around. Absolutely not. If you have found yourself in a situation where you've unexpectedly lost your job, that 401k that you have with that employer, you may not want to roll over immediately. And the reason for that is because more often than not, unless you confirm whether or not what you have in there can be transferred in kind, and this is again what Lorraine, John, and Chris will be able to go through with you, they may sell out, which then means you have to buy back into something all totally new again. You might want to just leave that alone and focus more so on what your emergency savings are, what other cash opportunities that you have in order to tap into, use those resources first before you touch anything that's in your 401k. Once and only once you've exhausted your other resources and you're able to be in a position now where you are building that cash position, then you can start looking again into potential investing opportunities. But for the most part, that 401k, you want to make sure that you are leaving alone the best as possible. So those are the kind of things that you can do to start your way to prepare just in case something happens. Now, let's say you do find yourself where your job has been terminated. What are the things that you need to be focusing on, and what should you be thinking about? Number one, your severance package. There's a couple of things that you want to make sure that you're reviewing in your agreement, your employment agreement, what that looks like beforehand. Make sure that you're getting the appropriate amount of severance weeks for the amount of years that you've worked. Oftentimes there is, well, not oftentimes, I think almost every time, there's going to be a clear statement of what that actually looks like and what that formula is. Generally, what works best for you would probably be asking to have all of that in one lump sum as opposed to kind of taking out. Do not, and this one is important because we see this a lot, unfortunately, because of the emotions that arise. don't leave money on the table. That's just silly. And when we talk about money on the table, it's whatever unused vacation days that you have, your health insurance situation. What does COBRA look like when it comes to a point of severance? Make sure that whatever bonus monies and commission payments you receive that anytime there are terminations that take place. There might be an opportunity for something different, a different opportunity that comes across. Ask for that. But the main thing is review your contract so that you don't leave anything aside. Walk out with as much as possible, including your health insurance. Immediately, you want to file for unemployment so that you're not caught in a bind where if your severance is paid out and then you need to have something to kind of cover you. When you are filing for unemployment, you may opt to have the taxes taken out. This way, later on, you don't have to deal with having to pay those taxes. And the other thing to note too, really try the best as possible. If you're receiving a severance, try not to collect when you're already receiving something, because it eventually can work against you. Also, make sure that you are reviewing when this situation applies. When you go on the unemployment websites, confirm the various state-by-state requirements to make sure that you are abiding by all things, including looking for part-time work. But what does that do to the actual unemployment check that you're receiving to cover you for the bills, the fixed expenses that you have? We touched on this a slide ago, but your health insurance. When you're leaving, generally you should get about 2 months of health insurance that's covered by your former employer. You want, even though this is going to be the most expensive option, the least disruption in your health insurance coverage may be to just stick with COBRA. Otherwise, you will have to look through and identify different health insurance plans that will be appropriate for you and your families. And so, yes, again, even though it might be the most expensive option, it does provide you that coverage with the least amount of disruption. So you don't know how long it may be before you're employed again, whether you have health insurance through your employer. So that's probably going to be one of the things, especially if you have a family to take care of. That might be your best option. With your rollovers that we did talk about beforehand, you've got a couple different options. You can take the money out entirely, which, as I said, may not be the best option at that point, but this is something certainly that you're going to want to talk to Lorraine and John and Carissa on. You can leave the money there until you find a new employer and have that money transferred over to the new employer 401k plan. Again, these are all different options that are available. In this situation, the main thing is, to the best of your ability, probably leave your 401k alone as best, and try not to touch it. Just because a lot of times when you're selling out of those assets, it may not be the most favorable time for you and your financial journey to do that. But these are questions that you're going to bring up to Lorraine and have them kind of advise you on what's going to be best for you there. As you look for new opportunities, while it's not fun to obviously be in a situation where you're unemployed and you have bills to pay and the like, as you're looking for something new, though, really ask yourself, maybe this is an opportunity to think back of what it is that I want to do. And we have here, what are your wishes? What are your wants? What's the thing that's going to keep you going and stay motivated? These are some things that you also want to consider in the way of possibly being a little more on the positive side and finding that silver lining in a situation that may not be best. Or maybe this was being terminated was the call that you needed in order to find the thing that you actually really want to do. And that might be more what you're looking for. And a part of that will include what your salary demands are. And don't be afraid to ask what your demands are and what's appropriate and what look and do the reviews to see what you're looking for in terms of your next career move and what those salary ranges are, and make sure that you are asking for that. Don't hold back on identifying those opportunities for you, because that'll also help you prepare even better and even more closer for those uncertain times as you build out your emergency savings and also look into more of the investing opportunities. You're probably fully aware, but when you do any Google search, you happen to find any of these search sites, but also use your networks. Rely on Lorraine and John and Carissa and ask them for different opportunities, different ideas, also what they know. They know you best. They know what you've been doing. You've been working with them. This is also a great opportunity to also engage your children. What are they looking for? What are the different avenues that they can go into to really ensure their well-being on their financial journey? That's Lorraine, that's pretty much what we have in terms of those prepared comments for those uncertain times, and really as it relates primarily to potential job loss and managing on the financial side your debt during that situation, going into how we can start looking and preparing ourselves from budgeting and saving aside for emergencies. I hope this has been helpful. I know that Lorraine, you mentioned at the top, it's a little bit more of kind of a back to basics, if you will, but there are times where fortunately this does happen, and it's a way to be able to engage and think about things to prepare for the future as best as possible, not just for yourself, but also that next gen. So again, thank you so much for your time this afternoon. I will turn it back over to you, Lorraine and John and Carissa, if there's anything else.
Oh, I think Lorraine might be on mute.
Oh,
Thank you very much.
If she realizes that.
Sorry. Yes. There we go. Oops. Here we go. Thank you so much, Janet, for that. And now we're going to have John go over some of the points that we've been talking to clients about, and just about the uncertain times that we're in. So I think you're going to find the next talking points very interesting. So with that, John, I'm going to turn it over to you.
Yeah, absolutely. So I'm going to go ahead and share a presentation. This is a presentation that's, if you've done a recent meeting with us, you will recognize some of these slides. And then to kind of get in a little bit to some of the uncertainty topic, we'll talk about some data points that aren't in these slides as well. So let me go ahead and just get this open really quickly. Let me just get this to here. And go back to Zoom and share this and share. And how is that? And
Perfect.
then,
yep.
All right. So then let me just get to the slideshow and press play from current slide. And then so I'm going to tie it right back to this, but we're going to kind of briefly talk about the economy. And we'll talk about recessions. And here is a funny thing about recessions is one of our pet peeves is whenever we hear people talk about recessions as if they're like a natural phenomenon, like seasons or eclipses or something that just comes and we're just wait for it. They have to have a reason. There has to be a purpose for a recession. And really what a recession is this just less activity. And so the consumer makes up about 70% of the economy. We've got businesses that are investing in their own capital. We've got the government doing spending. We've got our net export ratio. So are any of these things going to go down? And when we look at the consumer is still pretty healthy. Consumer confidence came out today. A little bit higher than what it was previously, but the consumer had noted that there's a little bit of concern about the labor market. That's going to tie us into this other thing that's been getting a little bit of note in the news, which I don't have a chart on it here, but I'll tell you about it really quickly. It's called the SOM rule. And essentially what the SOM rule is whenever you see a certain change in the unemployment rate over the previous 3-month period, that is a certain amount greater than the low in unemployment over the past 12 months. The idea is that that's kind of like a psychological break point for consumers to start holding back on spending and get more conservative. Well, the SOM rule just triggered, and so it is flashing recession. And JP Morgan just recently came out and they upped their recession predictions to 35% by the end of this year and 45% to the end of next year. Looking at their reasoning, they're thinking that the Eurozone, as we've talked about previously, looks a little more weak than what was expected. That's going to cause a little bit of a global slowdown in a few spots. But Banks look great in the US. Tier 1 capital ratios are still really strong. Consumer balance sheets still look pretty good here in the US. And, it's looking like the Fed's going to cut rates. So on an economic basis, there could be a little bit of a slowdown, but it doesn't look to be anything dramatic. But what we have shown right here is return on bonds. And so some people in our industry will refer to bonds as a safe haven, especially if you go on the high quality side around treasuries or high quality corporates like that. If you look at prices around any kind of scare or recession or whatever else, there might be a temporary little price down on bonds, but then they usually get right back up, and then they get ahead of equities on returns pretty quickly. So what we're looking at right here is average return post peak CD rates. So we've already seen peak CD rates. CD rates have already hit their highs. They've been coming down pretty consistently over the past 6 months. And once we hit that peak CD rate, and as we approach Fed rate cuts, because as you may know or may not, when the Fed cuts rates, the price of bonds that have fixed payments over a certain duration, their prices typically go up. They appreciate. So as rates come down, existing bonds appreciate. And so what we see here is on the 1 year, the blue one, 12-month CDs, on average, they still return about that 6%, which is what they've been on average. But that goes down over time. Short-term bonds will outperform CDs, and intermediate term bonds, let's say 7 to 10 years in duration, they will outperform all. Now, one quick note about bond pricing that we've observed. Like a lot of investments, whenever it happens, it can happen fast. And what that means is that price appreciation, that thing that takes it into double digits from its 5% payment, that can happen within a month or two. And so we want to caution people, if you're going to invest in bonds, let's invest in bonds, because you might see the price jump and like, ooh, I want some of that. It may have already happened. So just a little bit of a caution there. So let's go ahead and flip through some other things. Oh, next slide. Tomorrow, big day. NVIDIA giving their earnings call. We're feeling pretty decent about it. We listened to the earnings call of Amazon, Microsoft, Google, Facebook. They're all still buying NVIDIA GPUs, but we're hearing a little bit of cautionary voices. We think that NVIDIA is going to continue to, meet these high expectations, maybe not blow it out of the water like they have been doing. But what we're seeing here is this is the total return of AI investments. And one thing we want to note is that a lot of people have thrown out the word bubble. But when you look at the PE ratios, this is the price you pay to the earnings of these companies. For a lot of the companies you see reflected right here, those PE ratios over this period of time have actually gone down. So they've become less expensive from an earnings standpoint. So we're not necessarily thinking there's a major concern and a big pop, but like we saw in July, market participants are getting interested in other parts of the market like small caps, et cetera. And here's what I was talking about with the PE ratio. A lot of those had actually gone down over that period. And then the companies that did see it go up, like Supermicro and a few others, but for the most part, not too dramatic. So talking about the economy in general, maybe a recession, might not be a recession. Don't see anything that's going to be a major calamity on the horizon. If we do and stocks go down a little bit, great. Time to buy. We'll buy some more if that time comes out, because what we see is AI as a continuing opportunity. And there was actually a study done by JP Morgan in the past year that was really fascinating. And one of the things that they highlighted was that you have all these new innovations that eventually make it into the economy in general. And so what we have here in our chart is that we're kind of between AI infrastructure build out and companies creating in-market products. Tesla making their self-driving cars more ubiquitous, assistants on phones becoming more useful and ubiquitous, Netflix generating content just for you, which is, wild to think about. But there's this idea that AI is going to create movies that are specific just to you. incredible. So we're kind of in between those things happening, but eventually what's going to happen is that the technology is going to make the entire economy really kind of go into a little bit further. The idea, JP Morgan says that they expect about a 1% to our GDP overall by 2032. But the interesting part of what they had discussed was they said that when the steam engine was invented, it took 60 years for the steam engine to make its way into the economy as having an actual like lift to everything, to all over the economy in general. And then electricity, once that was, you don't really invent electricity, but once it became, the delivery of it was invented, 30 years. The internet age, 15 years before it really had a prominent effect on the economy. And they're saying for AI, less than 7. So almost half the time with each time, less than 7 years. So we got about another 5-ish years before you see a really strong boom on the overall economy. And that's going to feed the stock prices everywhere. It's going to feed the healthcare companies. They're going to become more efficient, all over industrials, et cetera. So what we're saying is, even if there is a little bit of recession, we see opportunities in bonds. That's great. Rates come down, get that boost. And then also, if stocks go down, could be an opportunity for the long run on those. And then as far as this year, what this is showing, this is in election years. And so we know that election years, more than average, stocks tend to be in the positive. So if you look at an average, about 2/3 of the time, indexes are positive. I think it's about 80% of the time in election years, the S&P 500 and other equity indices are positive. So you actually have a better track record in election years. And what this is showing is that that's really true in the summer months. In the summer months and building into the summer months in election year, much more positivity. September, October, a little bit more of a mixed bag. The blue line is percentage time it's positive, 50, 58%. So we could see the next month or two kind of, and this is going to coincide with potential rate cuts, but could run a little bit sideways. And then towards the end of the year, 83.3% positive in December. So, next couple months could just be a little bit of a breather as we get this election to shake out. Let's go into this next one here. So when we talk about recessions and Fed rate cuts, we took a look at it, and Fed rate cuts, how do they affect stock or equity performance? Well, ultimately, it does depend if we go into a recession. And so what we have here is the year of the first cut in a rate cut cycle, and then the subsequent 6-month return. And then in the final column, did a recession occur within 6 months? And as you can see, in the times when it was negative, a recession did occur within 6 months. If a recession did not occur within 6 months, it was positive. So what we're saying is, there could be, we don't see anything major on the horizon as far as like what could drive us into a major recession, but there could be a slowdown. It could cause a little bit of a pause in stock prices, could be a great buying opportunity. But right now we like the opportunity in bonds. So I'm going to go ahead and drop it there because that was a bit of information, and see if Lorene has anything she'd like to add.
Yeah, thank you, John. That was fantastic. Well, we're here to answer any specific questions that you might have about your own situation, and to go over more in depth the slides that John just showed. It is something that we are going over with each of our clients as we're meeting with them right now. So feel free to reach out to us if you haven't met with us recently, and we can go through it in more detail with you. And as always, if you have any questions, please let us know. So hopefully you found this information informative, and we look forward to having you on another one of our WealthWise Viewpoint webinars. So give us a call if you have any more questions. Thank you so much.